Hello, welcome to AmericaFirst Wealth Management Investment Outlook for Monday, April 28th, 2025. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at AmericaFirst Wealth Management. Here's our disclaimer. This material is just intended for information purposes only. We're not offering investment advice, recommending an offer to purchase or sell any securities. These opinions are expressed as of today and are subject to change without notice. Market highlights last week for the week ending April 25th. We had a strong market index rebound led by technology stocks. NASDAQ Composite surged almost 7%. S&P 500 gained 7.1%, and Dow Jones Industrial Average gained over 5%. With very robust earnings or positive outlooks from Alphabet, NVIDIA, and Tesla being the key drivers in the tech sector. Consumer sentiment, however, declined. The University of Michigan Consumer Sentiment Index fell, reflecting concerns over inflation and economic uncertainty. Bond yields eased slightly. The 10-year Treasury yield decreased 5 basis points, closing the week at 4.29%. And that suggested there was demand for government bonds amid the market volatility. Tariff uncertainties continued to persist despite the market showing a strong rebound. Investor sentiment remained cautious due to the ongoing U.S.-China trade tensions and potential tariff escalations. Treasury Secretary Bessent defended Trump's use of what he called quote-unquote strategic uncertainty in trade negotiations, describing it as a deliberate strategy to gain leverage over global trading partners. Also during the week, we saw that there are multiple polls indicating a significant drop in President Trump's approval ratings, with some showing the lowest levels for U.S. president within the first 100 days of a term since World War II. And this decline is largely attributed to public skepticism about his trade and economic policies. While that may indicate some people on one side of the political spectrum are cheering this, others would argue that if you look at Trump's history, every time the markets have declined or his polls have declined, he does something to get the markets going again. So I take these polls being a contrarian indicator. Nothing hurts Trump like stock market dropping or getting kicked in the polls. So he's obviously doing something about it. Whether or not it's deliberate use of strategic uncertainty, we do know his history in terms of making deals happen is something that we should not be betting against. A market outlook. This is a very busy week. Earnings are in focus. Approximately 180 S&P 500 companies, including a number of the Magnificent Seven names with Apple, Amazon, Microsoft, Meta, Visa, and ExxonMobil, are set to release quarterly earnings this week. And these reports will give us some insight into corporate performance amid the trade tensions and economic uncertainties going on. Last week it was definitely positive in terms of the earnings. This week will maybe a different picture, but we'll be focused on it closely. Key economic data for the week: April jobs report, first quarter GDP, and personal consumption expenditures data, and inflation data coming out this week. And again, we have trade policy uncertainty. There are a number of countries, certainly in DC, negotiating with the Treasury Department regarding trade, and certainly what's going on between U.S. and China remain at the forefront. We've been getting conflicting statements from U.S. officials and the Chinese government, both sides opposing each other publicly, but behind the scenes, they do appear to be talking, which was kind of what got the markets a little bit optimistic last week as well. But officially, there's no clear progress in trade negotiations, and I do believe that when they do announce something, it'll likely be something positive. So I think the markets, having dropped significantly earlier this year, are poised to recover if there's any positive news. Despite what's going on, market valuations do appear to be a little bit high in terms of fundamental overvaluation. And given the backdrop of potential economic slowdown and the impact of tariffs on corporate earnings, there have been some on Wall Street that have said that the index, the S&P 500, could end a year lower if these challenges persist, and that would warrant a reset evaluation based upon the current overvaluation levels. Turning to weekly market stats for the week ending April 25th, as we can clearly see here, a very positive week, all green for major stock indices, clearly led by the S&P 500 up 7.12%, and NASDAQ names as well. Growth dominated, as indicated by the Russell 1000 growth. Pretty much everything was green. Was a good week to be invested, pretty much across the board. We're starting to see some more green in the month to date, quarter to date. The 3 months still, and year to date is still red, but it was nice to see a bounce during the week. Whether or not it persists will remain to be seen, given what's coming up with earnings, economic outlook, and the ongoing tariff debate and discussions. Magnificent Seven names. Very strong week for Tesla as they reported lackluster earnings, but Elon Musk did indicate that he will be reducing his role with the government and Doge sometime in May. And he did promise that they were still on track for the lower price EV that they're working on. So investors saw that as a relief rally. The stock was down almost 40% from its peak. So sharp bounce here certainly was noticed during the week. Also very strong performance by Amazon, Nvidia, and Meta, all up over 9%. So very good week for the Magnificent Seven. Year to date, though, still have some work to be done, as many of these names are still down double digits percentage-wise year to date. Turning to sector performance for the week, as noted, tech-led and consumer discretionary on top as well. Communication services, and these are all three sectors where the Magnificent Seven names reside. So that's pretty obvious drivers in those sectors. The only sector that lagged was consumer staples, as investors and traders adopted a risk-on approach and got out of the risk-off consumer staple sector. Year to date, though, consumer staples and utilities are still leading, and we probably should continue to see some risk-off, risk-on type of volatility until there's stability in terms of trade policy, and hopefully there'll be some movement in terms of interest rates that's more constructive for liquidity. This is the S&P 500 one-year chart that we put up here. We decided to show the vertical lines, some key dates here. Election Day, November 5th, 2024. Inauguration Day, January 21st. And the so-called Trump Liberation Day on April 2nd. So those are kind of key dates we wanted to highlight. We also highlight the peak to trough drop, um, down 18.9% to the trough. Clearly a sharp bounce and rally from there. A sharp drop after Liberation Day with the tariff war being announced. And clearly a lot of volatility, a lot going on with technicals. The RSI has been on the bottom, has been a pretty good indicator for technical overbought and oversold regions. We do pay attention to that because the market direction does seem to be following it. 10-day moving average is also something we've been following, and we're now showing a bullish signal, being that the S&P 500 line is above the 10-day moving average. The RSI is rising. So technically, short term looks a bit more bullish now. But again, we'll wait to see what happens with earnings and economic data, as well as the tariff discussions this week. Turning to the dollar index, which has been something we've been focused on, we have reached a support level, and we are concerned about that support level being breached. Dollar does look very oversold here. You look down below on the RSI. There could be a rally and bounce in the dollar here. Whether or not it will continue to rise from there or fall further remains to be seen. But clearly it's a critical indicator as we watch and ponder whether or not the world will continue to pursue dollar de-dollarization strategies, reducing the dependence on the US dollar as a reserve currency. Our opinion is that that's probably going to happen, but it's going to take a while to manifest itself. It can't be done in a drastic way. But even at the margin, slight shifts away from the dollar as a reserve currency will have some dramatic impact in terms of trade and the role of the U.S. in global trade, global economics going forward. But for the short term and moderate term, I don't think we need to worry about that. But it does change our viewpoint in terms of how we should be positioning in specific sectors, and also with respect to how companies are strategizing and positioning themselves. It does have profound long-term impact. So we do watch the dollar carefully. Gold continues to be something we focus on. We did highlight that the chart was incredibly bullish, and it still remains to be very strong. And we look at central bank buying in gold since 2008, after the last financial crisis. That trend continues to remain uninterrupted. We do also note that the mining of gold is a finite resource, and production of gold is not growing in any rapid means, but demand for gold, both by central banks, buying in Asia, especially in China, and even inflows into gold ETFs, which we've been seeing pretty much worldwide, and more recently, buying in gold ETFs in the US has picked up as well. So the trend for gold continues to be higher. May see some short-term dips, but looks like these dips are being bought. And gold is just one of these assets that people buy and hold on to for a long time. So we do think that the trend continues to be quite bullish and golden for gold. Bitcoin, as we pointed out before, it was holding above the 200-day moving average, and now it's risen above that. The Bitcoin chart does look bullish, and we like it because we do feel that not only is Bitcoin potentially part of this de-dollarization long-term trend, but also it's become a coincident or slightly leading indicator for the S&P 500 in recent months, so we do like to track it. We are getting a little bit towards the oversold region on the RSI, and that kind of is timing itself with current market earnings. Bitcoin is trying to make a run towards the $100,000 mark again, closing last week at just under 94,000. But the trend remains pretty bullish here. We are constructive on Bitcoin, and we've used it as an indicator of what's happening in the world. 10-year Treasury yields, as we mentioned, had a 5 basis point dip last week, reflecting demand. And that's obviously an improvement in liquidity and bodes well for the markets when Treasury yields dip. However, we do need to see sustained dip in the long-term Treasury rates, which will prompt greater liquidity and demand in depressed sectors like real estate and construction markets right now. So hopefully we'll see a further decline in Treasury yields. Turning to the yield curve, the blue line being on the bottom relative to the December 31, which is the orange, and prior week, April 17th, you do see a dip across the yield curve. Again, the short end of the yield curve is still inverted. Short-term rates remain high relative to rates down to pretty much up to the 10-year mark. Short-term rates do continue to be an attractive place to be. We have noted before that Warren Buffett has a huge amount of cash via Berkshire Hathaway, I believe over 350 billion in short-term treasury bills. So earning over 4% in short-term treasury bills while riding out the volatility, by his reckoning, seems to be a prudent place to be. And certainly being a value investor with valuations slightly higher, he's just waiting for better opportunity. So with that in mind, we do need to see the Fed move on short-term rates at some point. As we know, Powell and the Federal Reserve in their last meeting had said that they were not cutting rates at the last meeting. We'll wait to see what they say during the May meeting. Forecast is for them to remain steady on rates and not change them. They remain concerned about potential inflation due to the tariffs. However, we do note that when you look back at history, the Smoot-Hawley Tariff Act in the 1930s led to the Great Depression and a huge deflation, dropping in prices. So hopefully Powell is aware of that. We have noted there have been reductions in prices, at least for U.S. consumers, in terms of food and fuel. And we're seeing some signs that cost of housing prices and rents are at least stabilizing or slightly dropping in some areas. Hopefully the Fed is paying attention to that data. And Trump has been jumping up and down for the Fed to lower rates. And there was some debate about whether or not he would try to remove Powell, even though legally he cannot do it. Just the threat alone created some volatility last week. But then Trump backtracked and said that he would not do anything to remove Powell. The markets recovered once he said that. So a lot of rhetoric going on that we need to pay attention to. It's creating a lot of volatility. However, we do believe that short-term rates should be lower, and hopefully the Fed will note that the economic data, by our reckoning, does support that short-term rates should be lowered. The question is when and by how much. Turning to the economic calendar, The highlights, the key data for the week: Monday, Dallas Fed Manufacturing Index. On Tuesday, we've got the JOLTS job openings, be the key data point. You can see highlighted in red here. Jumping to Wednesday, we've got the GDP, core PCE numbers, personal income and personal spending. Thursday, we got the ISM manufacturing as well as the initial jobless claims. And on Friday, non-farm payrolls and unemployment rate. And earnings, I'm not going to run through all of these. We've got over 180 of them. So I'm just going to flip through these. If anyone would like a copy of this, please reach out to us. We'll be happy to send a copy of this to you via email. The Wednesday, huge amount of earnings on Wednesday. And Thursday, before the open and after the close. So Wednesday and Thursday will be a whole lot of earnings reports. So expect to see a lot of trading activity and potential volatility Wednesday and Thursday. Friday, okay. Friday again. And that wraps up our investment outlook for the week. And if anyone would like to reach out and schedule a call with us, please feel free to contact me or Jim Monahan via email. And we'll be happy to provide you with more detail or information about our thoughts. Or if you would like to learn more about our products and services, please also reach out. Thanks for tuning in again this week. I'm Dan Liu, and this is America First Wealth Management. Bye bye.